We will have Suresh Madan speak on pre-money valuation. Suresh is an Executive Vice President and Portfolio Manager with Excalibur Management Incorporated. He manages equity funds focused on investing in emerging growth companies. Mr. Madan has also managed money for multi-million-dollar Reichmann family for nearly 10 years. He has about 30 years of experience in North America, Middle East, and South Asia. He is also the chairman of IIM US Incorporated, a pan-IIM organization in whole of North America. He is also the president of the TIDE, and it is under his leadership that a lot of new programs have been launched in the Toronto chapter. Suresh has a brilliant academic record. He is an engineer, he is an MBA, and he is a Bachelor of Science degree. And all three of them, he got gold medals in their respective university and institutions. He is also a chartered financial analyst and a Canadian investment manager. Please join me welcome Suresh for his.
Thank you, Lalit. Thank you, Lalit, and welcome to everybody. Good evening and good day to everybody who is listening to us over the webcast. I am going to be focusing on value. The reason I thought I will focus on value is, as an entrepreneur, I've been engaged and involved with entrepreneurial programs, and we hear a lot of presentations, very interesting presentations describing the technology, describing the opportunity, and also telling the strengths of the management. But when we want to cut a deal, you don't know how much are you looking to raise and how much are you willing to give. If you were to go and sell your car, first of all, anybody will ask you how much it is. If you have ever sold a house, people will like to know how much it is. Or if you put anything on a Craigslist, now many entrepreneurs are trying to market their company, sell part of the company, and they don't know how much it is. So I'll be covering the value. The value is also important for an entrepreneur because as an entrepreneur and as specifically for startup, you really don't make enough money. You take minimum possible from your business, and the only inspiration which makes you continue to do month after month, year after year, is whether the company is increasing in its value. So if you have method and way to determine what is company worth, then it will also give you a sense whether you are succeeding or you are not succeeding. And if you're not succeeding, you've got to think of something else to do rather than continuing to work for the company. So I'm going to be focusing much more on value. Lalit did give some of my background, but and I have volunteered for TIE for a number of years, and so I know many of you here. But I am today talking as an investment fund manager who have seen these entrepreneurs for the last 15 years and have funded companies over the last 15 years. So what do we see? And hopefully I'll be able to give you a little perspective from an investor, which would help you in determining what the other side is looking. Also, prior to being a fund manager, I was a business valuation consultant for a Big Four accounting firm, and I've seen how values are determined for companies. I'm industry agnostic. I've invested in technology companies, I've invested in clean tech companies, healthcare companies, consumer product companies, and we have been lately looking quite a lot on the mines. Jim mentioned about mining industry. Well, I have invested in mines because I do see returns there. We are return focused, and therefore we invested. This is a shot of a mine in northern Quebec where the temperature at that time was minus 50 degrees Celsius. I had an opportunity to go and visit. And Jim also mentioned about agri-food, and that's an area I have been very, very interested in, and I've been investing in Canadian farms and agri-technology companies. This is a shot of a trip I made in Saskatchewan where the farmer came in his plane to pick us up and take us directly to his farm. So very excited to go and visit such a huge facility. So let's focus on valuation. Valuation is required when you are looking for financing. you need to know how much your company is worth so that you can start to negotiate and strike the deal. Valuation is also important when you are trying to sell the company or enter into a strategic transaction with another potential party. It may be a client, it may be a customer, it may be a supplier or whosoever. Many of you may have an opportunity to purchase your own family business. Valuation is again an important criteria when there is a generational change and when you are looking to purchase family business. So for valuation, we are focusing on financial fundamentals, but valuation is not a single number. It's not purely science. There's a lot of art in it, and therefore valuation does vary, and presentation, audience, as well as timing does matter when you are trying to value the business. Barry gave you a very, very good outline of sources of finance, and he did highlight on informal sources, government grants, as well as equity sources, which we all know, and these are obviously very important. The fact is, for the venture capitalists, for the startup companies, equity sources are still the most important set of sources. There are, however, some sources of debt as well, which I like to point out. For example, there is a bank line of credit. Many of them involve personal guarantee, as Chad mentioned a little while ago. That could become a challenge, but early stage companies, when you do not have a history, that may be a source, including sometimes even your own credit card. BDC has some program where they give debt. Factoring is another possible source, and don't know if everybody here knows about factoring. If you have a client and if you have sold a product, you have an invoice, you will be able to sell that invoice to a third party. So there are companies focusing on factoring, and they will discount the invoice right away. The invoice may be for 90 days or 60 days or whatever time it is, but you can get the money right away by selling your invoice. So that's an opportunity to raise money. You can also lease, depending on, typically for a startup company, there is a small equipment required, if you have software or any other technology, and those equipment can be leased. And then rest is your own overheads and working capital, which of course you'll have to fund and find other sources of equity or debt. If you have received a venture capital, it becomes more easier to find that. All four major commercial banks in Canada and many other credit unions, etc., do fund if you have a VC funding already. Because after all, for debt market, it's very important. The banks follow the 5 C's of credit. They want to see your character. Now, if you are into your second venture, and if you already made a success previously, of course your credit worthiness is much better, and it's much more easier to find money. I've seen ventures where there was no personal guarantee involved, and banks did funding of a couple of $1 million without any guarantee from the company. It was obviously secured debt to the corporation. But this type of venture will happen only if the promoter or the entrepreneur has a previous history of success. Banks are looking at the repayment capacity. Banks will always ask you for projections, and if you give projections, those projections will form the conditions. So you've got to be realistic in your projections, because if you don't achieve the projections, then you're not fulfilling the conditions, and the bank has a right to call their money, and their money is senior to any other money that you have in the company. So these are some of the important sources, and very important to look at them. Now, once you have raised, when you go about raising the money, you will look at different approaches of valuation. Of course, you can call in a consultant, but startups typically will like to do it yourself. You have to understand what the value is, and therefore you can strike a good deal. First and foremost method anybody uses is discounted cash flow. Discounted cash flow is nothing but present value of expected future cash flows. Now, you take expected cash flow over a period of time from the project, net of any reinvestment or capital needs, and look at the growth rate, and then discount them at a reasonable rate. Now, as in a startup situation, it becomes very tricky. If you have a stable operating business, you have a history of few years, then discounted cash flow becomes easier, and that's the most common method. In fact, this is the method used by Warren Buffett and many of the other investors. It involves an extensive study of understanding the projections, understanding the risks involved to arrive at the discount rate, understanding the growth rate in the capital, and is generally the first most preferred if it is possible to use. But discounted cash flow sometimes is difficult to use, so people rely on a comparable method. So you take a set of comparable firms and try and arrive at a standard parameter like price to earning or price to book or price to sale and some of these parameters, and arrive at. This is even more easier to use if you're not selling the whole company. If you're selling part of the equity, then it's easier to price your equity. I put some of the comparables here for IT services company because many of you are in the IT services area. Even though these companies may be comparable, but numbers are not still the same. And actually these numbers are almost about a week old. And so the numbers have actually deteriorated as the stock market has declined over the last few days. But what you need to do is, if you are in a specific industry, if you can find a public company in that specific industry, then you can use its price to book value or price to earning or price to sale and get you a sense of what your value should be. For startup situations, many times we do not even use price to earning or price to, because you don't have earning. And book values are initially very, very small, so they are not a good comparison. So an easier method to do valuation for startup would be to try to take an industry-based metric and use a public company's metric to your own metric to arrive at a value. For example, if you are providing internet services and you have a set of customers, so a rough estimate of value will be $100 per customer. If you have a million customers, you are worth $100 million. If you have 1,000 users, now it will also depend on how sticky these users are and how engaged these users are and how long these users have been there. But it gives you a sense of how much you can spend to acquire a customer, because every customer acquisition has an expense. And this is typically the method. Now Facebook, as you know, is a private company, but that's being valued based on their 700 million customer users currently at about $100 per user. If you are an IT services company, the average of a number of IT services company in US is about $64,000 per employee. So based on number of employees and number of seats you have, you get a little bit sense. It's a little more easier when you have more harder assets. For example, if you're a gold mining company, an investor would typically pay currently about $160,000 of proven gold in the ground. Or if you're a silver mining company, it's about $2.50 per ounce of silver in the ground, which are about 10% of expected potential revenue from these companies. So what you need to do is, depending on your industry, you go to identify specific metrics which would apply to you and use that as a parameter to value your own company. Another method would be an option valuation, which are more easy to quantify. And some of the examples of options are, for example, patents or resources on the ground and things like that. Recently Google bought Motorola Mobility primarily for its patent portfolio, and they paid, it's estimated after the operating cost and revenue which they will expect from the existing cash flow and the business, they paid about $9.5 billion for that patent portfolio. Eastman Kodak is almost a bankrupt company. They're distressed at this point in time, but they're being valued in the market at about $500 million, primarily because of the patent portfolio. Or BlackBerry has a huge value. Now, a study of different patents were found out, and it was arrived at that approximate value of a patent is about $110,000. So it gives you a sense of how much you can afford and how much you can spend to get a patent. It's very important. We have I4I is a very interesting example of a small Canadian company which had one patent, and this patent was infringed by Microsoft. And so they went and filed a litigation against Microsoft, and after about 10 years of extensive litigation, finally they have won in the US Supreme Court, and Microsoft has to pay about $300 million for that single patent. So patent can be different, and a single patent, but patents do have value. So when you have an intellectual property and you have to focus on developing that property. You have to see that you're spending money because it helps generate additional value. In fact, many companies keep their patents in a separate legal entity than the cash flow. In a startup, that will really not be applicable because of you're not selling separate pieces of the company. But it's very, very common in pharmaceutical industry where the R&D is done in a separate activity and patents of drugs are in a separate legal entity versus cash flows from that particular product. As investors, we would typically look at the cost approach, and one reason is cost approach typically gives the lowest amount of value. So we want to see what's the bottom, and so we like to know how much have you spent, how long you have been working, and what was the cost of various assets you bought. If you bought any patent or any intellectual property right, or you developed it, so how much have you spent in that? What's the replacement value of those? One of the things which startups typically forget to add is they don't really count their sweat equity. You know, as it was mentioned a few minutes ago, for a software company, the cost may be $50,000, but actually the cost is not $50,000. It is the out-of-pocket cost of either licensing some software, pieces of software or tools, or buying some hardware on which you had to develop these tools. The real cost of developing that software is all the man months and man days which were used in writing the code and testing it out and sending it to the customer and getting a feedback and improving it and things like that. And we as entrepreneurs typically do not account for those and do not provide for those. So one method could be, we should, even in a startup company, we should pay ourselves a salary which cannot be paid in cash, so it will be paid in terms of either a debt to the company or an equity to the company, so that when your books do reflect actual cost of developing that particular business, because as investors we will look at what is the cost you spend, because that gives one of the parameter of valuation. Another method which is very important to understand and is to be used is what is clearly known as the venture capital method of valuation. There is a sense of apathy or distrust with the VC community, especially and I just want to raise this because we feel VCs are not doing their job, they're not investing, they're not giving the right valuation, or they're not interested in many companies. But if you understand this VC method of valuation, which Barry did point out in his presentation a little bit, then you will see their perspective and see what can be approached to them in terms of financing. Typically, about 1 of 10 ventures succeed. Venture capital itself is a very, very, very risky business, and many ventures fail. Some do come out essentially at a break even, of course, and it's only 1 out of the 10 which will really succeed. Now, typical VC fund is based on, investors in a VC fund are people who are high net worth individuals, or sometimes pension funds or other endowment funds, etc., who put in a small bit of money. Because VC industry is more riskier than mutual fund industry or other industries, the expected rate of return from these investments is higher. Typically, the investors are looking at about 20 to 24% net annual return after paying all fees. And VCs, to manage the investment, also have to generate some fees. So typically a VC must return 25 to 30%. Now, if that return has to be earned from 1 out of the 10, because 9 may fail and only 1 will succeed, then what will happen is the VC has a very high requirement to earn a return. A VC will invest for typically 5-year period. There will be an exit, there will be delay. The way VC funds are generally structured is there's a minimum 5-year commitment and a maximum of 2 periods of extension of 3 years each, so 8 or 11 depending on the industry. So a VC typically would return the money in about 8 years' time to their investor. And after giving a 24% annualized return, he has to generate 20 times. From the investment he is making, he must generate 20 times, otherwise it does not make economic sense for a VC. So if a company is, if he is investing $1 million in a company and is taking 25% of the company, so the value of the company is about $4 million, he should not invest unless he thinks the company can be sold for $80 million a few years down the line. If the company can be sold for $80 million, then it makes sense to invest. If the company cannot be sold for $80 million, so to sell the company at $80 million, it must address a significantly large market. It must have a significant market share. It must have a niche technology to be able to sell. And if the company cannot be sold, then he cannot put in his $1 million. So when you are looking to raise money from a VC, you have to factor in these factors. Can you get $1 million? You can get $1 million if 5 years or 8 years down the line the company can be sold for 80 million. If the company cannot be sold for 80 million, you will not be able to get that $1 million today. So it's important to understand the arithmetic involved in VC. Now our situation is a little more specific because in many cases we don't have cash flow, so we are basing on sector projections. People do understand the product life cycle, but you have to prepare projections which are more reasonable and realistic. In my 15 years of investing, I really have not yet found a realistic projection because none of the projections have actually met. So when you bring in a projections to us, we will apply our own discount factors to see what we think is more likely to happen, and therefore we have to see whether it is worth 80 million 5 years down the line or not. We will also adjust for the margins. Initially, typically the margins are low. So we will typically use a historical growth rate and historical margin in your industry to arrive at. We will also, most of the time, the investors, entrepreneurs estimate their growth rate at a much higher rate. So we'll have to adjust that to the industry growth. In many cases, there are no history. So we'll have to consider other comparables in that industry to arrive at. And it's important for you to understand what these comparables can be used. And if there are no comparables and unique situations, so we'll have to see a trend of margins and revenue. If there is no long history, we'll have to see month to month for last many months and things like that. So going over, we have focused quite a lot on valuation. And valuation is what will get you funding. If you have a certain valuation, then you can afford to sell 25% or 30% equity of that company, you can get an X amount of price. So what are these strategies as an entrepreneur you need to focus on or think on to enhance and create value? So three main areas. You have to have barrier to entry, which could be by way of some intellectual property rights or first mover advantage or branding. Look at the value many of the US brands have obtained. I mean, with top brand is everybody knows is Apple, $153 billion. So there is a huge value for these barriers to entry. Then you have to find a competitive advantage. And this applies to any industry. It could be a very specific sanctioned monopoly. For example, if you were to do a diagnostic lab in Ontario, each of these labs have their own catchment area, and they are monopolies in their respective catchment area. So they could be monopolies within a different types of industries. There are obviously monopolies with resource sector and utility sector and a number of other areas. You also try to sign various types of exclusive agreements, whether it's a supplier or a customer or marketing agreement of any kind. That does create a competitive advantage and create additional value for you. And when you are developing a product, a method of creating value would also be to create certain barriers to exit, so that your customers don't just walk away. A new product comes in, a new technology comes in, customers may have an easy time leaving. Create a sticky product, so that customers have. For Facebook is a very sticky product. People have uploaded their videos, their pictures, their material, they have all kinds of information on themselves, and it is extremely difficult to go and change and find someone else, because you'll have to do, as a user, you'll have to spend so much time in recreating what you created on Facebook. So you have no incentive to leave, and it's too much expensive for you to leave in terms of your time. Or create a strategy where there is a difficulty for customers to simply walk away. So switching costs or cancellation policies or things of that kind, which are very important in creating value. and which are used by a number of people. Once you have created and use these overall strategies to create, then you have to focus on different parameters, how you can improve that value. After creating it, you'll have to improve the cash flow, efficiency, improve new, add new features to the product, increase the market share, go into new markets, reduce your capex needs, so that ultimately you generate higher amount of cash, which is used for discounted cash flow valuation. Now, the valuation is not on a single day. The process of valuation has to be continued as you go along with your venture, because at different points of time you'll get a value, and ideally you should be improving your value. And that's the increase in the overall value of the company is the reward which you are ultimately going to get as an entrepreneur. If you have created a value and you have a product and you have cash flow, then it's very important to look at your cost of capital, because in terms of discount rate, the cost of capital is what is critical. So you'll have to look at, Barry did mention about going public or reverse takeover strategies, or finding capital from other sources, or exiting of your previous sources of financing and going into a new sources of financing, which may be more economical and cheaper for you. And so you have to keep thinking of changing your financial mix. So I will spend a little bit on, as an investor, what are we looking for? Of course, we are looking for business model, and we're looking for the depth of management and the management team's strength. But we are also looking at the capital structure. We want clean capital structure. We don't want too many complicated rights, because that impact, especially for me, I do invest in companies which are a little bit later stage than what Barry invests or what Jim, and sometimes we help them exit of their positions by putting in additional and larger amount of capital. So what we are specifically looking for is the depth of management team, and understanding from management whether they know their strengths and they know their weaknesses, whether they have a sustainability plan, and they have a commitment to take the company to the next stage. Whether it may be, sometimes we find an entrepreneur is not willing to give up. He is not even willing to sell. He does not want to lose control. He is so much paranoid with his control, and that limits the growth. That limits the opportunity to grow that organization forward. We are also very, very clear on, when we invest, we want a significant market opportunity. Barry did mention about a $1 billion market. As an investor, it is very important to put in capital in areas where market opportunity is very big. So if your market opportunity is only worth a few $1 million, you cannot raise $500,000 even. Why? Because if the market opportunity is small, the value of your company will stay small, and for any investor to come in, he will only give 1/20th of whatever that capital you're looking for. So it is very important to address, when you are looking at your business ideas, it's very important to specifically focus on larger market opportunities, which is a key. And as an investor, we are very, very clear on no surprises. We do not. That's very important to keep your systems, accounts, your structure and disclosure up front, so that we don't see any undisclosed lawsuits or loss of any major customer or employee or advisor, and we don't want to see any financial misstatement. So these are very, very critical when you are looking for financing. Typically, we have seen it takes time to get financing. Even though it's a 2-minute pitch and you have to attract the investor to listen to you next time just in 2 minutes, but closing of financing could take time. We will have a number of 2-minute pitches, and then there will be a due diligence, and then there will be visits, and there will be second visit and the third visit. So this process is long. So you've got to be ready for that process. It could take, we have seen on an average, it takes almost 6 months to close from the day you identify. So if it is going to take 6 months to close the financing, you need to clearly know as to how much financing you need to do, because financing is not for which you are running your business. You are running your business to develop technology, to go to customers, to look at, to improve the product, and ultimately sell the product and satisfy the customers. Financing invariably is a distraction for management, and especially for startup, when you do not have much depth, you have very few people, sometimes only 1 or 2 people, financing can be a huge distraction. So when you are looking for financing, you need to look for financing for at least 18 months ahead, and also to achieve a major cycle, because neither we will want you to keep coming back to the market, and nor you will be having enough time to focus, and the negotiations can go on and on sometimes. So you need to be prepared for all those negotiations when you are looking for financing. But again, fundamentals are critical, and your financial fundamentals will ultimately determine the value and will determine the success on which you can sell the company. But that's all I have to say. Since I've done a lot of investing, I will be happy to entertain any questions on specific situations or specific financing questions.